Good morning and welcome back to Margin. This morning we're going to talk about my thoughts on the FIRE movement. This is part one of a two-part series, so let's jump right into it. So you've probably heard of the FIRE movement. The FIRE movement is financial independence, retire early. This movement was arguably begun back in the early 1990s when Joe Dominguez and Vicki Robin wrote a book called Your Money or Your Life. Now, I've brought up this book before. It was a recent read for me, even though the book was written quite a long time ago now. But the book really focuses in on the FIRE movement, even though at that time they didn't call it that. So there's a popular blogger named Pete Adney who is otherwise known as Mr. Money Mustache, and he built a community around the FIRE movement up in Boulder, Colorado. Now, what he really focused in on was taking those principles from Your Money or Your Life, that original concept, and expanding upon it to build a community around that topic. And so as he has moved along, he has brought many people on the path of financial independence through the lens of finding what matters most to individuals and then basically planning out an early retirement or the option to retire early based on structuring your personal finances around making those things happen. So this approach of simplicity in the way that you're living has been coined originally by him. He was originally an engineer who was able to work with his wife to amass about 25 times their annual spending in order to retire around the age of 30. So they went through that process early on, kind of told their story, and then from that amassed a great deal of readership because of other people looking for this lifestyle, looking to accomplish this lifestyle as well. So Mr. Money Mustache refers to this as a very successful marketing campaign per se that's been targeted on the backs of Americans. And so basically he has looked at this through the lens of trading your time for money, that money for stuff, and then basically spending your time not only making the money, but then maintaining the stuff. And so many Americans don't realize that trap that you can get locked into and you get stuck in because you have so much stuff to maintain. So therefore you then have to make a certain amount of money in order to live the lifestyle you've built up. So there was a book by Scott Rikens called Playing with FIRE. So FIRE, of course, is the acronym for Financial Independence, Retire Early. And he goes through the process of feeling the pressure of society and of marketing to have certain things at certain points in time, and then having to then maintain those things. So one day he was traveling to work, he was commuting to work. He basically was listening to a podcast by Tim Ferriss. And on that podcast, Mr. Money Mustache was on that podcast basically explaining his new lifestyle, explaining his lifestyle that he had gained because of financial independence. And so as Scott was listening to this, he was thinking about, okay, well, this guy basically is living off of $25,000 to $27,000 per year, he and his wife and their kid. And how is that even possible? Now, at the time, Scott was living in Southern California. He was living in Coronado, which is a very expensive part of Southern California. So even buying a shack down in that area would be $600,000 or more. And so he started evaluating his life and evaluating the different expenses between the nice cars and eating out and having what they have. And he and his wife basically began the conversation, had the conversation around the life that they wanted to live versus the life that they were living. And so they built out a all-encompassing plan of figuring out, okay, how to actually exit the rat race, how to build up those savings and move to a less expensive part of the United States and so on and so forth. So Scott went through that process that he outlined in his book, and it really transformed his life. So as Scott was listening to Pete, or otherwise known as Mr. Money Mustache, talk about how he had saved 25 times his annual spending by the age of 30, around the age of 30, in order to retire and basically plan on spending $25,000 to $27,000 per year in order to do that, and utilizing real estate and index funds to accomplish that, it piqued his interest. It piqued the interest of Scott in figuring out what would this look like in order for me to translate my income to wealth, in order for me to then live off that wealth to be able to live the life I want to live. So those of the FIRE community operate off the 4% rule. And they have this rule of thumb that you basically save up 25 times your annual spending and you invest that so that then you can live off of 4% of basically the proceeds of the growth. And so it's very much so growth focused. The aspect of scrutiny, I would say, that the FIRE community has gotten in recent times has been the fact that interest rates are at historical lows. And also cap rates on rental properties or on investment properties are also very low. And so when you're looking at the aspects of that 4% rule working well, obviously you're looking at interest rates. You're also looking at how your investments perform. Now, fortunately, in the last couple of years, the investment side, outside of the market volatility in the beginning of last year, has been very positive for many people. And people have seen some pretty great returns. And so the interest rate and also the cap rates on rental properties may be less of an issue because of that. So the FIRE community focuses a lot on the safe withdrawal rate, which basically prevents you from killing your nest egg by going into your nest egg prematurely and dwindling that. But really it focuses on the growth of what you have saved and the reoccurring income that you have built up. So it's focused on, okay, living off of that income and not, living off of the nest egg that you've built along the way. And so through that process, it's recommended that you invest in a index fund. I personally use Vanguard index funds, and basically it's focused in on people utilizing index funds, which are low cost. They have low management fees. And have a lot of perks in that aspect. It's also looking at a wide stroke of the S&P 500 or whatever you're invested in versus going out and investing in individual stocks that have a tendency to be a little bit more volatile, and you want to be mindful of that. So overall, this reduces the risk. And if you're not having someone actively manage your investment portfolio, you're also paying lower cost when it comes to an index fund versus a mutual fund, and having that mutual fund managed by a fund manager. And so when you're looking at streamlining that process, investing into index funds and looking at how you can then use the money that you do make to diversify into other areas like real estate. So this focus in on index funds in particular has been further validated by people like Tony Robbins and Warren Buffett. And that is mainly because the actively managed mutual funds typically don't beat the S&P 500. They typically don't outperform that. And so therefore, when you're looking at an index fund, it will be slightly lower risk because it's more diversified than, of course, having individual stocks. But also beyond that, you're going to have lower fees and lower cost of managing year to year those specific index funds. So whether you look at the simple path to wealth or you look at the mad fientist, across the board, you typically find very consistent themes in regards to planning for what brings you the most joy and actually focusing on the happiness component of only buying things that actually add value to your life. So this moves you from a place where you have to work in order to maintain your lifestyle to a place where you are really focused in on what brings the most value to you and only planning for resources to be applied to those specific areas. If this information is helpful to you, please do like, subscribe, and hit the notification bell so you're reminded to come back on a daily basis and improve in managing your personal finances. Thank you for your time. Enjoy your day, and we'll see you back here tomorrow.